for 10 years, and company use a 15% discount rate to evaluate the project, right? As you can see, the same thing has been shown in the form of in the form of table. So these are the cash flow. First year it will receive 6,000, second year also 6,000, third year 6,000, till 10 year it will receive 6,000. And then we find the present value factor, we multiply both of them to get the present value, and then we get the cumulative PPV. So this is just a table given for your convenience. Now the question is, which of the following statement is correct about the project payback period? Very good question, right? Which statement is correct regarding the project payback period? That is what has been asked. So option number A, the simple payback period is 10 years, matching the discounted payback period. Option B, the discounted payback period is 5 years and it ignores the time value of money. The simple payback period is 5 years, but the discounted payback period is 10 years due to 15% discount rate. Option number D, both payback methods show 3 years as the project recover cost early. So this question checks your concept regarding simple payback and discounted payback. So you have to find what is the simple payback period and what is the discounted payback period, right? We have discussed this payback period in the last lecture. So do you know how to go about solving this question? So what is the meaning of simple payback period? Let me explain. What is the meaning of simple payback period? It is just how long it takes to recover the initial investment. How long it takes to recover the initial investment, right? That is called simple payback period, initial investment. So we ignore any time value of money in the simple payback period. So can you tell me what will be the payback period as per the simple? What will be the payback period? We have discussed in the last lecture. Just let me know in the chat box. What will be the simple payback period? Just let me know. Very simple, very easy, right? How to find simple payback period? In the numerator, you write the initial investment. In the numerator, you write the initial investment. In the denominator, you write the cash inflow. And just divide both of them, you will get the simple payback period. So please tell me how much it is. Any response from your side? How much is the simple payback period? It is nothing. What is the initial investment? What is the initial investment here? So in this case, the initial investment is, as you can see, 30,000, right? Initial investment is 30,000. Annual cash flow is 6,000, right? So divide both of them, you will get what? You will get 5, right? So this 5 is what? 5 is the simple payback period, 5 years. So this 5 year is the simple payback period. Please let me know. I'm not getting any response. I think you know it, right? I think you know how to calculate the simple payback period. So just you have to divide the initial investment by the cash inflow. So this 5 year is what we call the simple payback period. Now come back to the discounted payback period, right? This one is new. Let me explain how to find the discounted payback period. If you have any doubt anywhere, please let me know, right? So if we talk about the discounted payback period, it is little different. The demerit of simple payback period was that it does not take time value of money into consideration. But if we talk about this discounted payback period, let me write it down. Discounted payback period method, it takes time value into consideration. It takes the time value of money, right? Time value of money. It means that future cash inflow are worth less than cash inflow today. So we need to discount. And what is the discounting rate? 15%. And that is what has been done in this particular table, right? In this particular table, as you can see, the same thing has been done. Very good morning to all of you. So this is our first question of today's session. Let me again, for those people who have joined late, right? Let me again read the question. What this question is all about. See, what is happening in this case, that a project require initial investment of rupees 30,000. It generate an annual cash inflow of 6,000 for 10 years, right? And company use a 15% discount rate, right? And this table has been given for your convenience. In this table, you can see there are 10 years, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. The second column shows you the cash flow, right? Cash flow means how much is the cash in form? 6,000 every year. First year 6,000 you get, second year 6,000 you get, third year 6,000 you get, and you have invested 30,000, and 10th year also 6,000. Then we have the present value factor. You know what is present value factor? It is nothing but 1 upon 1 plus r whole to the power n. So what is r here? R is the discounting factor. So 1 upon 1 plus 0.15. And what is n? So for first year n is equal to 1, for second year n is equal to 2, for third year n is equal to 3. That's why you see this value. And when we multiply this cash flow with their respective present value factor, you will get the present value, right? You will get the present value. So what we have done, we have multiplied this, so we get this. multiply this, we get this, multiply this, we get, and finally we find a cumulative PV. Now the question is, which of the following statement is correct? Again I'm repeating because some people have joined late. So option number A, simple payback period is 10 year, discounted payback period is 5 year. Option C, simple payback period is 5 year, but discounted payback period is 10 year. And option number D, both payback period shows 3 year, at the project recover cost early. So in the last lecture, I told you how to find the simple payback period. If you remember, it is very simple, because simple payback period does not take time value of money into consideration, right? It does not take time value of money. So if you want to find the simple payback period, just write the initial investment in the numerator, and just write the cash inflow in the denominator. Right, you did not take time value of money into consideration. What is the initial investment? 30,000. Just write 30,000 in the numerator. And what is the cash inflow? 6,000. Just write 6,000 in the denominator. How much it is? 5 years. So as per the simple payback period method, simple payback period is how much? 5 years. Right. Now come back to discounted payback period. There are two kinds of payback period, simple payback period and discounted payback period. Now let's calculate the discounted payback period. Right. Simple payback means what? How much time it will take to recover your initial money. So you have invested 30,000 and every month, every year you are getting 6,000. So obviously it will take 5 years to recover the entire money back. That is called simple payback period method. But if you talk about the discounted payback period method, it takes time value of money into consideration, right? If you talk about discounted PP means payback period, it takes time value of money into consideration. You know what is the meaning of time value of money? It says that future cash flow are worth less than cash flow today. And what is the discounting factor? 15%. So you can see we have already find the PVF for you. PVF we have already find, and cumulative we have also find. Now can you tell me what will be the discounted payback period method? As you can see, cumulative is almost 30,114. So can you tell me what will be the discounted payback period method? The discounted payback period, as you can see, the cumulative PV is 30,114. So let's go through the options. The option number 1 says that 10 years. Simple payback period is 10 years. So this is incorrect. Why? Because simple payback period is 5 years. What about option B? So because in this case, what it is happening? So can you tell me what is the discounted payback period method based on this particular table? I have drawn this table for you. In examination, it might not be given, right? So I have drawn this table for calculating the cumulative cash flow, cumulative present value. So can you tell me how much time it is taking to recover the entire 30,000 amount? See, in first year we have recovered just 5,220. In second year we have recovered the 9,756, and so on. In the 10th year we have recovered 30,114. So can you tell me what is the discounted payback period? Just tell me. Let me know whether your concept is clear or not regarding. I told you now. What is the meaning of payback period? How much time it will take to recover the initial invested amount? So you have invested 30,000. How much time it will take, as per discounted payback period method, to recover that amount? Tell me how much time it is taking. 10 year. Very good. It is taking 10 year. As you can see, in the 10th year, our cumulative is 30,114. Right. So the correct answer to this question is option number C. Right. So because after the 10th year, the cumulative PV is 30,114, which exceed the 30,000. Right. So this is the initial investment. So it takes about 10 years to fully recover the amount. Exact is not 10 year, 10 point something, but we can call it 10 year. Right. So simple payback period is 5 year and discounted payback is 10 year. So what we learn from this question, see how to go about finding the discounted payback period method. You have to draw this table. Remember, this table will not be given in the examination. Sometimes you have to draw it yourself, right? I have given this just for your convenience. In the examination, this table will not be given. So what you will do, you will draw 5 column: year, cash flow, PVF, PV, and cumulative PV. This 5 column you will draw. In the first column, you will write the year. How many years are there? 10 years are there. So just write 1, 2, 3, 4 till 10. Then you will write the annual cash flow. So it is a uniform annual cash flow, 6,000 every year, 6,000, 6,000. Then you will find the present value factor. How to find the present value factor? 1 upon 1 plus r whole to the power n. R in this case is discounting factor, which is 15%. And what is N? N varies. N is the number of year. So for N is equal to 1, just put the value and get the result. You will get 0.870. For N is equal to 2, you will get 0.756. So this will give you present value factor, PVF. Now what you do? You multiply the cash flow with PVF to get the PV. Similarly, cash flow with PVF to get the PV. And I think you know how to find the cumulative PV. Very easy. You just add both of them, and finally cumulative PV you are getting this much. Is it clear? Please tell me. So what we learned from this question is that simple payback period is quite efficient and easy to calculate, but discounted payback period method consider the time value of money, right? So I hope it is clear now. Let's come back to the next question, right? So this is our next question. This is the explanation part. Yes. So this is the question. Let me zoom a little bit so that the question is clearly visible to you. Let's see what question is asking. So friends, the question is Take a Style. Take a Style is a fashion retail company, right? It is a fashion retail company. It is evaluating a new project. Fine. They estimate revenue. They estimate expenses, and over the next 3 year, they estimate revenue and expense over the next 3 year, right? To determine if the project is worth investing in. To determine the project viability. Viability means if the project is worth investing in. They prefer using methods, right, that are based on accounting information, right, that is easy to access and familiar to the business world, rather than relying on the long term cash flow projection. So that is the question. So which of the following statement best describe a key characteristics of the accounting rate of return method that make it appealing to Take a Style, but also highlight a significant limitation? So this question is about ARR. ARR, accounting rate of return. Option A, ARR consider the time value of money and relies on complex cash flow forecast, making it suitable for long-term project. Option B, ARR is profit-centric, use readily available accounting data, and is easy to understand, but it ignores the time value of money. Option C, ARR is cash flow centric, consider the time value of money, and require estimate only for the first year. And the option number D, ARR relies on detailed market analysis, provide a precise rate of return, and account for all possible risks. So this question is about accounting rate of return. If you know it, you can answer it clearly, right? Accounting rate of return. What is accounting rate of return? Let me explain. So basically, this is a method. If you talk about the accounting rate of return, this is a kind of method, right? That measures the average accounting profit. What it measures? It measures the average accounting profit, right? It measures the average accounting profit from a project related to the initial investment. It measures the average accounting profit from a project related to the initial investment. Simply, you can say it tells you how much profit a company expect to make from a project every year compared to what it invested in the project. Try to understand it. See, on one part you have the investment that the company has invested. On the other part you have the profit. So basically it compare investment as well as profit. It says that it tells you how much profit a company expect to make from a project every year. How much profit a company expect to make from a project every year compared to what it invested initially. Now what is happening here? There is a company called Take Style. As you can see, this Take Style company. This Take Style like the method, right? You can see this Take Style is preferring the method called ARR. Why it is preferring the method called ARR? Because the reason is profit, right? The reason is profit. So can you tell me why ARR, why this Take Style is preferring this ARR method or accounting rate of return method? Because accounting rate of return method, right, is based on profit. It is based on profit, right? Like your which is readily available. This profit, this profit you can get from your financial statement. From your financial statement you can easily get the profit, right? And also it uses the average. It uses the average annual profit. What it use the average annual profit. We will do one numerical based on it in the upcoming slide, but this is the theoretical question. This question is about what are the benefits of ARR and what are the limitation of ARR. So two things. First thing is that it use profit which is readily available in the financial statement, and second thing is that it uses the average annual profit over the life of project. And so what is the formula for calculating ARR? It is very simple. In the numerator you write the average annual profit, and in the denominator you write the initial investment. This is how we calculate ARR, accounting rate of return. Average annual profit upon initial investment. Now can you tell me the answer? What is the key characteristics of ARR and what is the limitation of ARR? One question, both have been given. Limitation as well as characteristics. Can you tell me the answer of this? So take a style like ARR method because it is simple, quick, and uses information that is already available in the company financial statement. Because in the company financial statement, profit is available, profit data is available, right? But there is a limitation also. There is a limitation of this method also. What is the limitation? It does not takes into account time value of money. Remember, time value of money, it does not takes into account. You know what is the meaning of time value of money? That means it does not takes into account that money today is worth more than money tomorrow, right? So let me give you one example. For example, suppose a project generate a lot of profit. Suppose a project generate lot of profit in the latter year. In the latter year, suppose the project generate a lot of profit, right? So the ARR method treats it the same as profit generated in the first year. That is the demerit of this ARR. It does not take time value of money into consideration. Suppose a project generate lot of profit in the latter part of the year, right? So the ARR method treats it the same as the profit generated in the first year. So what do you think? So because time value of money is very crucial, because money received sooner is more valuable than the same amount that you receive later, right? So let's go through option. Any answer from your side? Which option do you think is correct? Any answer about ARR? Right. What do you think is the correct answer here? Which option do you think is correct? So let me explain. Let me go option by option. Option number A, it says that ARR consider the time value of money. Do you think it is correct? No. ARR does not consider time value of money. This is incorrect. So option number A, option number A is incorrect. What about option number B? ARR is profit centric, uses readily available accounting data, and is easy to understand, but it ignores the time value of money. Exactly. This is the correct answer. Because ARR focus on profit. You know the formula? The formula is average annual profit. In the numerator, we write average annual profit. In the denominator, we write initial investment. This is how we calculate ARR. What is ARR? ARR means accounting rate of return, right? So option B is the correct. It is profit centric. It uses readily available data, easy to understand. What about option C? ARR is cash flow centric. This is wrong because ARR is not focused on cash flow. It's about profit, right? Rate of return means profit. It's about profit. And option D, ARR relies on detailed market analysis. This is also incorrect. Why? Because ARR use accounting data. It does not use detailed market analysis, and it does not account for all this. Please tell me, is it clear or not? Or do you want me to explain it again? Please let me know. Yes, B is the correct answer. I hope the concept is clear regarding the ARR. What is the merit and what is the demerit of accounting rate of return? In examination, what happened that they ask you some questions like limitations and merits of ARR. So what we learned from this question, what is learning from this question, that ARR is simple, accounting rate of return method is simple, it is profit based, that is easy to calculate. However, ARR ignore the time value of money, which make it less accurate for evaluating long term project. So please tell me, would you prefer ARR for long term project, yes or no? Please tell me. This is a very good question. क्या आप accounting rate of return method को long term project के लिए prefer करेंगे? Yes or no? Please type in the chat box. Would you prefer accounting rate of return method for long term project? What do you think? Yes or no? So the answer is no. You will not prefer it. आप नहीं prefer करेंगे. Why? Because long term, because ARR does not take time value of money into consideration, right? ARR, accounting rate of return, ignores the time value of money, which make it less accurate for evaluating long term project. And it is very good for a company like TechStyle. For this type of company called TechStyle, it is very good method. It is very perfect method because it is a simple method based on the available data, but is not ideal for project that has spent many years or have cash inflow that come later, right? I hope that is clear now. Now, friends, let's come back to this question. Now, this is a numerical based question based on ARR. I hope everyone has pen, paper and calculator. सभी के पास पेन पेपर कैलकुलेटर होना चाहिए, तभी जाके इस क्वेश्चन को आप सॉल्व कर पाएंगे. आइए देखते हैं इस क्वेश्चन को. So what the question is asking, there is a scenario presented before you. The question is, that A Limited, they invested 3 lakh rupees in a project that has 3-year lifetime and salvage value of rupees 90,000. Annual profit before depreciation is 1,50,000 and depreciation is 70,000 rupees per year. So there are three methods of calculating ARR: version 1, version 2, version 3. So version 1 is about annual basis. So using annual basis of ARR, what is the ARR for year number 3? So this is what you have to calculate. You have to calculate the accounting rate of return for year number 3. So just now I told you the formula. In the previous slide, I told you the formula of ARR. Let me again write down the formula. I am writing the formula of ARR here. So the formula of ARR is profit before depreciation. Profit before depreciation divided by investment at the beginning of year. Investment at beginning multiplied by 100. Right? Sorry, profit before or profit after. Just wait a minute. There is a mistake. Profit after, not profit before. Profit after depreciation. Right? Divided by investment at the beginning multiplied by 100, because ARR takes profit into consideration. In the case of payback period method, in place of profit, we take what? We take, right, investment divided by cash flow. But here we are taking profit, right? Now you have to apply this formula to calculate the ARR. So can you calculate it for me? How much value you are getting? So write profit after depreciation in the numerator, investment at the beginning in denominator. So what does that mean? That it, let's break down into two parts. The first part is profit after depreciation. So this is the annual profit that we account for after we account for depreciation. Depreciation is a kind of non-cash expense. I told you early in the last lecture, depreciation is a kind of non-cash expense that reduce the value of project over the time. And in the denominator, we have the investment at the beginning. So what is the meaning of investment at the beginning? This is the value of the project at the start of that year, right? At the start of that year, the value of project, that is called, investment at the beginning, right? So how to calculate the investment? See, investment at the beginning of year, and you have to calculate for year number 3. You can see you have to calculate the ARR for year number 3. So how to calculate the ARR for year number 3? So there is a formula. Sorry, how to calculate the investment at the beginning of? Can you tell me what is the investment at the beginning of third year? So what you have to do? You have to find the initial investment, and you have to subtract the depreciation accumulated until that point. Then you will get investment at the beginning of the year, right? So in initial investment, subtract the depreciation accumulated, right? And this is how you calculate the investment at the beginning of the year. Now in year number 3, come back to the question. In year number 3, what are the data available? So annual profit before depreciation is how much? 1,50,000. Annual depreciation is 70,000. And can you calculate me what is the initial investment at the beginning of year number 3? Can you calculate? Can you write the value in the chat box? What is the initial investment at the beginning of year number 3? Just waiting for your response. If you know the concept of depreciation, you can easily tell me. Can you tell me what is the initial investment at the beginning of year number 3? So let me explain. See, very easy. Initial investment was 33 lakh, right? 3 lakh. After 1 year, uh, you know, it is a straight line method. So it get depreciated. So one way you can think of like this: total year is how much? 3 year, right? And what is the salvage value? Salvage value is 90,000. So just add 90,000 plus 70,000. This is the initial investment at the beginning of year number 3, which is how much? 1,60,000. Right? Is it clear or not? Please tell me. Why we have added the salvage value to the depreciation? Because this is a kind of a straight line method. The depreciation, the this particular project is depreciating in uniformly every year. It is depreciating by 70,000. You have to calculate what is the initial investment at the beginning of year number 3. So what we did, we started from the last, that is the salvage value, which is 90,000, and we added the depreciation over year number 3, which is 70,000, and we get the investment at the beginning of year number 3. Please tell me, is it clear or not? If it is not clear, I will explain it again, because this is the main thing that you have to take into consideration: initial investment at the beginning of the year, right? So since depreciation reduces the value of project, so that is why initial investment at the beginning of year is 1,60,000. Now let's calculate the step by step, right? What is the profit after depreciation? Can you tell me? What is the numerator? Numerator is profit after depreciation. In short, we write PAD, profit after depreciation. How much you can calculate it? It is nothing but profit before depreciation minus depreciation, right? And what is the profit before depreciation? You can see 1,50,000. 1,50,000. And what is depreciation? 70,000, right? So just subtract 70,000 from 1,50,000. How much is the profit after depreciation? It is 80,000, right? So we have profit after depreciation and we have initial investment at the beginning of 3 years. Okay, not clear. Okay, fine. Let me explain. See what is happening here. See, main thing is initial investment at the beginning of 3 years. See, let me explain. See what is happening here. See, so initially how much invested? 3 lakh, right? And after at the this is year number one. This is year number one. So after how much is the depreciation? 70,000 is the depreciation, right, for the year number one. So how much will the value be? Just subtract the 70,000 from 3 lakh. It will be 2,30,000. I'm just explaining why we get the initial investment as 1,60,000. Now year number two, how much is the depreciation? 70,000. Just subtract the 70,000. How much it is? 1,60,000. So you can see at the end of year number two, the investment value is 1,60,000. Or we can also call it at the beginning of year number three, the investment value is 1,60,000. Now is it clear why we have taken 1,60,000? One another way to do it, we start from the last. So in the last, what we get? The salvage value. What is the salvage value? In the question it is given. Salvage value is how much? 90,000. Right. The salvage value is 90,000, which means the residual value is 90,000. And how many year? 3 year. So in the third year, it would have depreciated by 70,000. We just add, right? You will get 1,60,000. So either you come down or you go up. Both will give you the same result. 1,60,000 investment at the beginning of 3 year. Please tell me, is it clear now? Please tell me. See, we are just applying the concept of depreciation. Nothing, no any rocket science. Very easy to understand. We are just depreciating the project value by 70,000 every year, and you have to calculate what is the project value at the beginning of 3 year. Right? Either you move top down or you move bottom up. Right? You will get the same result. Very good. So now, very good. Now let's come back to this question. So I think PAD you can easily calculate it. Profit before depreciation minus depreciation. So what is profit before depreciation? 1,50,000 minus 70,000. So it is how much? 80,000, right? Now just apply the formula. In the numerator, you write what? In the numerator, you will write the profit after depreciation, which is 80,000, and divided by 1,60,000. So how much is the answer? Can you tell me what is the answer? It is 50%, right? So the answer is option number C, right? Is it clear or not? Please let me know. This concept is very, very important. No, it is C, because profit after depreciation is profit before depreciation minus depreciation, right? Yes, it is C. Very good. It is C. So is the concept clear? I hope it is clear now, right? How to go about finding the ARR? There are three versions on the basis of, this is called annual basis, right? This is called annual basis. Remember that the thing which we have discussed now is called the annual basis. I hope it is clear now. The correct answer is 50%. Now, just remember the formula, you can get easily answer it. Now let's look at the second question. The same question, second part. Now, using version number 2. What is version number 2? The version number 2 is called the total investment basis, right? It is called the total investment basis. Now you have to calculate the overall ARR for the project. See, in the first question, you were asked to calculate ARR for year number 3, right? See the difference. In this question, what was asked? What you have been asked to calculate the accounting rate of return for year number 3. That is why it is called annual basis. Suppose question asked you to calculate ARR for year number 2, you can calculate it, right? So similarly, but in this case, what is happening? It is asked overall ARR for the project. That is called total investment. This is the second version. So you have to calculate the overall ARR, not just particular year ARR, overall ARR. So how to go about calculating it? Again, formula remain the same, right? So again, let me come back to this particular question. This is the data. You have to apply this data, right? You have to calculate the overall ARR. So you have to just apply this data to calculate the overall ARR, which is the version 2 of the ARR method. So the key difference between the version 2 is that we treat the total investment as fixed, ignoring the depreciation. We don't take depreciation into account. We take the total investment as fixed. right? That is one of the key difference of the version number 2. So the formula remains the same. What is the formula? To calculate the accounting rate of return, in the numerator we write the average annual profit. Average annual profit. In that case, we were not taking average annual profit, we are just taking the profit. But in this case, we are taking average annual profit, and we will divide by the total initial investment. Total initial investment, and multiply it by 100, right? So this is the formula we will use for version number 2. So what is the average annual, what is the average? Oh, one answer I'm getting 34.78. Let me check whether it is correct or not. So can you tell me what is the average annual profit? So the problem tells us that annual profit after depreciation, right? Okay, so annual profit after depreciation is how much? Annual profit after depreciation is 80,000 per year, isn't it? Just subtract these two, 80,000 per year, right? So it means that average annual profit is how much? 80,000, right? And what is the initial investment? 3 lakh. So just write 80,000 in the numerator and just write 3 lakh in the denominator and just multiply it by 100. How much you are getting? Please tell me. See this thing. You have to understand that what is the formula? Average annual profit, because we are taking total investment, right? Since we are taking total investment, so we will write the average annual profit divided by the total investment, right? So average annual profit is how much? 80,000, right? Because the question itself says you, right? Because the question itself says that that profit before depreciation is 1,50,000 and depreciation is 70,000. So profit after depreciation is 80,000. So 80,000 divided by 3 lakh into 100. How much it is? I think you are getting 26.67%. Please let me know. Is it what you are getting? Yes, very good. So the answer to this question is answer to this question is option number A, right? So please tell me, is it clear? So this is called version 2 of ARR. It is calculated using the average annual profit and the total initial investment. We ignore depreciation. In this case, we don't take depreciation into account because we treat the entire investment as constant. We treat the entire investment as constant, right? So answer is 26.67%. I hope it is clear now. Now, friends, let's take the third version. There are three versions of calculating ARR, right? If you have any doubt, any place, please just you can ask for me, because this is an interactive session. The main benefit of this session is that you can ask your doubt, right? I will clear it. So now let's look at the third version of the ARR, that is called average investment basis. Now you have to calculate using version number 3 what is the ARR, right? So again, come back to this question. Let me show you the question. So what is version number 3? It's about average investment basis, right? So let's come back to this question. You have to calculate ARR based on average investment basis. Same question but 3 version, right? How to go about calculating the ARR using the average investment basis? So again, problem is the same, right? Company is investing 3 lakh in a project with 3-year life. Salvage value is given. Annual profit before depreciation is given. Depreciation is given, and you have to calculate the ARR using average investment. See the wording. Wording is very much important, right? So this version is a bit more realistic than the previous one because it considers the declining value of asset over the time. It takes into account that the project initial investment reduce in value over its life because the company expect to sell for a salvage value at the end. So it use average investment, right? As the name itself suggests, it use average investment over the life of project. How to find the average investment, right? And can you tell me how to find the average investment? So the formula is very simple. To calculate ARR, in the numerator, you will write the average annual profit. You will write the average annual profit, but in the denominator, you will write the average investment. That is the difference. In the previous case, we have just taken the total investment. We have not taken the average investment. But since this is average investment, so in the denominator, you will take the average investment. So do you know how to go about calculating the average investment? You know how to find the average investment of anything? Right? See, it is very simple to understand. You can see that what is our initial investment? Initial investment is what? Initial investment is 3 lakh, right? So initial investment is how much? 3 lakh. This is the initial value. And what is the final value which remains after 3 years, which is called salvage value, which is 90,000. This is the final value which remains, right? So how to find the average investment? Very simple. Average, initial plus final divided by 2. That is how you find the average, right? So average is equal to initial plus final divided by 2. So initial is how much? 3 lakh. Final is how much? 90,000. Divide both by 2. So how much it is? 1 lakh 95,000. You know how to find the average, right? So initial investment and the final value that remains, right? That is called salvage value. So that is the point. That is what you have to understand. Plus the salvage value and then divide by 2. You have to get, then you will get the average investment, right? So is it clear now? So average investment is 1,95,000. And what is the our numerator? Our numerator is average annual profit. How to find the average annual profit? So you can see annual profit before depreciation is 1,50,000 and depreciation is 70,000. So just subtract both of them. This will give you annual profit after depreciation. How much it is? 80,000. Right? It is 80,000. Is it clear? So it is 80,000. Now friends, in the numerator, we will write 80,000. In the denominator, we will write 1,95,000 multiplied by 100 to get the percentage. Can you tell me what value are you getting? Please let me know what value are you getting. In the numerator, just write 80,000. In the denominator, just write, 1,95,000. So what is the value you are getting? Please let me know. So I am getting, 41.03%. Please tell me, are you getting the same? So 41.03%, right? So this is the value, right? So let me come back to this question. So this is the third question, as you can see. So the answer is 41.03%, right? So this is called ARR, ARR value number three. Average investment basis. So right now, let's summarize the learning from the three ARR, right? So this is the summary. There are three versions of calculating the ARR. Yes, very good. So version number one, which is annual basis. What we did in the what? Let me again write on the formula. How did we calculate the ARR based on version number one? That is on annual basis. What was the formula which were used? You remember the formula? In the case of ARR number one, in a particular year, it shows the yearly performance, right? It will ask you to calculate what is the ARR over year two, what is ARR over year one, what is ARR over year three. That is called yearly performance. So that is what we write profit after depreciation in the numerator, and we write the initial investment at the beginning of the year, right? Initial investment at the beginning of year, at beginning into 100. This is what we use to calculate version number one. Version number two is about the total investment. How did we calculate? We write the average annual profit. We write the average annual profit and we divide by the initial investment, total investment. Total investment. It is simpler but less accurate because it ignores the depreciation multiplied by 100. This is the version number two. And version number three, just now we have seen in the numerator, we write average annual profit, and in the denominator, what we do, we write average investment and multiply it by 100. So it is more balanced. It considers the asset value reduction. So these are the summary of the three versions which we have just discussed. Please tell me, is this three version clear? Because question will be asked. One case study is sure short asked every year from this ARR, accounting rate of return. It checks your understanding whether, so whenever 1 year ARR is asked for year number one, year number two, year number three, go for version number one. Whenever average investment is asked, then go for version number three, right? And whenever that total based on total investment is asked, go for version number two. So just one case study. I hope it is clear. Very good. Now friends, one question for you, right? Let me give you one question to solve. Now this question you try yourself, right? Let me check where your understanding, how much you have understand. A company, so let me check your understanding. So the question is, a company invest 10 lakh in a project and earn total profit after tax and depreciation of 4,60,000 over 5 years. The salvage value of machinery at the end of 5 years is 80,000. So what is ARR if calculated using the initial investment method, right? So what is ARR if calculated using the initial? So just now I told you, three methods: annual basis, total investment, average investment. Right. So now please tell how to go about calculating it. So please try this question on your own. I'm just giving you 1 minute, and then I will explain. Right. Okay, fine. Sufficient time. I think you might have calculated it. Let me explain how to find ARR for this method. Okay, so one answer I'm getting A. Let me explain. See what we have to do in this case. Initial investment, right? So in the so we have to take initial investment. What is the formula we have to use? We will write the average annual profit. Average annual profit. We divide it by the initial investment. Sorry for my handwriting, just understand initial investment multiplied by 100, right? So this is how we calculate the ARR, accounting rate of return. Now what is important to note is that this method does not consider things like time value of money or the salvage value of machinery, right? So now let's calculate the average annual profit. What is the average annual profit? So total profit after tax and depreciation is given 4,60,000 over 5 years, right? So this is total depreciation, total PAD for 5 years. So what is the average annual profit? It is nothing but 4,60,000 divided by 5, because this is our total 5 year. So what is our one average? How to find the average for 1 year, right? So basically divided by 5. So how much it is? 92,000. So your average annual profit is, I hope everyone have calculated, because once you solve yourself and then see the explanation, this is the best way of learning. If you don't solve it, then you will not understand it, because numerical question can be best understood if you solve it first yourself. That is why I give you time to calculate it, so you will know your mistake from what went wrong, and you will not commit the same mistake in the examination, right? So let's come back to this question. So 4,60,000, which is our total profit, just divided by 5, this will give you the average, which is how much? 92,000. I hope that makes sense to you. We are just taking the total profit and dividing it by the number of year to get the average profit per year. Right now, we have to calculate the ARR. Initial investment is given 10 lakh. Just apply the formula. In the numerator, we will write 92,000. In the denominator, we will write 10 lakh and just multiply it by 100. Very good. One answer I have got, 9.2%. Very good. Excellent. Right. I hope it is clear now. 9.2% is the answer. I hope everyone, yes, everyone is getting 9.2. Very good to see that all of you have understood. Right. So this is our version number 2. This is our version number 2. Right. ARR, I hope the concept is clear now. If any doubt, please raise the question. I hope it is clear. Very easy to understand this ARR concept. Now, friends, let's try this one. The same company now want to compute ARR using average investment, which consider the salvage value of 80,000. So, what is the ARR using average investment? Please tell me. Just giving you 1 minute to solve. So, using average investment, the same company want to compute ARR. Salvage value is 80,000. What is ARR using average investment? Let's come back to this data. This is the data, and salvage value they have given 80,000, right? They want to calculate using average investment method. Can you do the calculation? How much percentage you are getting using average investment method? Okay, so let me explain how to go about calculating it, the average using the average investment method. So basically, in this case, what will happen, that our average annual profit will remain the same, right? Which is how much? 92,000. Just now we have calculated. Average annual profit is remain the same, which is 92,000. But but in this case, see, I think there is one thing. I think there one mistake we have done in the previous question. Let me explain that. I have wrongly calculated the average, right? So what is the exact formula to calculate the average? Let me explain. See how to go about calculating the average. I think one mistake I have done in the previous case. Let me correct that mistake here. See, whenever we want to calculate the average in this case, see what is happening here. Let me explain using a graph. So using this graph, you can easily understand. See what is happening here. So this is this is a linear decrease. Initial value is how much? Initial value. This please try to understand this thing. Very very important. So initial value is how much? 10 lakh, right? So just let me down 10 lakh, right? Let me write it down there, 10 lakh. And what is the final value? There is one mistake we have done in the last question. I'm just correcting it. And the final value is 80,000. This is the final value. And we want to calculate the average, right? We want to calculate the average. Do you know how to calculate the average of this? So basically using the graph you can easily understand it. So let me use this particular space to make you clear, right, how to find the average of this case, right, because we have to calculate average investment, right. So graphical way is the best way to understand it. So suppose this is the graph, right, initial value is how much, 10 lakh, final value is how much, somewhere here 80,000, 80k, right, we have to find the average. So we have to find middle point. What is the middle point, right? And this one, suppose this is the middle point, suppose this is x, this is middle point, this is what we are interested in finding, right? So how to find the middle point? It is very simple. Please try to understand how to find the middle point. First of all, what we will do, see this middle point, right, this middle point will be somewhere middle of this 10 lakh and 80,000, right. So this is somewhere middle of it, 10 lakh and 80,000, right. So what we will do, this one is, so right, see what is happening here, this one is okay, let me erase it, because in the book they have directly given you the formula, but I'm explaining why that formula came, because once you understand the reason behind that formula you can easily understand. So this one is how much, 10 lakh, this height which I have drawn by red color, and this one is how much, 80k, right, 80,000, right. So how much is this much, let me use different color, right, how much is this much, I'm using the green color, how much is this, it is nothing but 10 lakh minus 80,000, isn't it? Which I have drawn by green color, 10 lakh minus 80,000. And the midpoint of it, this is the midpoint. So you just divide it by 2, right? So 10 lakh minus 80,000 divided by 2, this is the midpoint, right? So how much it is? Just calculate 10 lakh minus 80,000. It is 9 lakh, 9 lakh 20,000. There is one mistake which we have done in the previous question. I am correcting it. So 9 lakh 20,000 divided by 2. How much it is? It is, 4 lakh 60,000. 4 lakh 60,000, right. So basically what is this, that this much height, try to understand this, very very important, this much height is how much, 4 lakh 60,000, but we are interested in this much. So what we need to do, we need to add this one, right, we need to add this one, and this one is how much, 80,000. So this plus this is equal to this, so 4 lakh 60,000 plus 80,000, this will give you what, 5 lakh 40,000, and this is our average investment. The answer is 5 lakh 40,000 is the average investment. I think one mistake was there in the previous question, right? That is what I'm telling you. In your book they have written down the formula like this: half of 10 lakh minus 80,000 and plus 80,000. This formula they have given, right? How did you get this formula? That is what I have explained using this graph. So this is the average investment. So this is how much, 9 lakh 20,000 divided by 2 plus 80,000. So it is how much, 4 lakh 60,000 plus 80,000. It is how much, 5 lakh 40,000. So this is your average investment, right? And what is your average profit? Average profit is 92,000, I think. Yes. So 92,000 divided by 5 lakh 40,000 multiplied by 100, right? So how much it is? 17.04%. Yeah, 17.04% is the correct answer, right? The previous question it was some mistake. I will again correct it, right? So this is how this formula you have to use, right? So whenever you want to find the average investment, suppose initially they have invested I1, right? And the salvage value is suppose I2. So half of I1 minus I2 plus I2, right? This is the average investment formula. This is how you will calculate the average investment. And this thing, why this formula? So this can be easily understood using this particular graph, right? The graph which I have drawn here. So no need to go into that deep. Just remember this formula, right? You will that will be enough. So whenever you have to find the average investment, just apply this formula: half of I1 minus I2 plus I2. What is I1? I1 is the initial investment. What is I2? I2 is the salvage value, right? And that is all. That will work. Okay. Now friends, let's see the next one. So this is one question, right? Let's come back to this question. What is happening here, that Jeta Corp, right? So basically in this question you can see Jeta Corporation is evaluating a weird project, unconventional project, right? With the cash flow pattern. You can see first year they are getting, they are losing 100, suppose it is crore, right? All data in crores, in $1,000,000. So first year they are losing $100 million in the 0 year. It means they have invested, right? They have invested $100 million. You know what is the meaning of this zero? Negative. Negative means, the cash is going out of the company. So it means they have invested this, right? In the first year, the cash inflow is $320 million. In the second year, they are losing this much. In the third year, they are getting this much, right? So it start negative, then jump to positive, and then dip negative again, right? Then what happened? The finance team calculate the project IRR, IRR, internal rate of return, right? And got two answer. They got two answer. The first answer they got 15%, and the second answer they got 40%. They are getting two internal rate of return, right? But when they calculated NPV, you know what is NPV? NPV means net present value, right? So when they calculated NPV, right, at 10% WACC, which is called weighted average cost of capital, 10% WACC, right? They got a negative NPV. So question is, what is the most critical limitation of relying solely on IRR for decision making in this scenario? Option A, IRR ignore the project scale. Option B, multiple IRR arise due to non-conventional cash flow. Option C, IRR assume in reinvestment at project rate. And option D, IRR conflict with NPV when cash flow change sign. Right. So basically, question is regarding the limitation of IRR. That is what it asks you. So you know what is the meaning of IRR, internal rate of return? Right. Let me explain. IRR, internal rate of return is the rate at which NPV becomes zero. I think you must have learned this in your AFM, JIB AFM, right? So when net present value you equate to zero, then that rate of return is called IRR, right? So that is exactly what is happening here. See, they are jumping, right? So now you can see earlier it is negative, then it become positive, then again it become negative, then again positive. This is called jumping, right? Moving up, moving down, moving up, moving down. So you can see this cash flow is jumping, right? This is called non-conventional cash flow pattern. What it is called? Non-unconventional cash flow pattern, right? So when this happen, IRR does not give us just one number. Rather, it gives multiple IRR. You see, on one time it is giving you 15%. On one time it is giving you 40%. So they will give you multiple IRR, right? Which is super confusing. You may think, wow, I am getting 40% return, but hold on, your NPV at WACC is 10%, which is destroying the value, which is negative, right? Which is destroying the value. So, what do you think the correct answer? What do you think the correct answer? Option number A. So see, option number B, that multiple IRR arise due to non-conventional cash flow complicating interpretation. Most critical limitation of relying solely on IRR, right? IRR can mislead you, right? Option B is a symptom. You see, multiple IRR is a kind of symptom, right? But the real problem is option number D. IRR conflict with NPV when cash flow change sign. IRR can mislead you when it conflict with NPV, especially if cash flow change sign multiple times, right? So that is the limitation of internal rate of return method, right? So the correct answer to this question is option number D. Please let me know, is it clear? So that is one of the critical limitation of this internal rate of return, that it conflict with NPV when cash flow changes the sign. As you can see in this case, sometime it is jumping, sometime it is going down, going up. That's it. So IRR is not always reliable if cash flow are irregular. This is called irregular cash flow. So NPV is your gold standard. It tells you whether value is created at your real cost of capital or not, right? So that is what this question explained. I hope everything is clear. I'm not getting any response. Okay, I'm again explaining. See, what is happening in this case, that cash flow is varying. Sometime it is negative, sometime it is positive, right? So internal rate of return means what? Internal rate of return is a way of calculating the investment return, right? So what you do, you equate NPV to zero. NPV, net present value. NPV is the net present value. How to calculate the NPV? It is nothing but summation of CI upon 1 plus RI to the power n. I is equal to 1 to I is equal to n is equal to 0 minus CI is equal to 0. So we will discuss it later how to calculate the NPV. So you equate NPV to 0. Corresponding rate of return is called internal rate of return. What happen whenever in those cases, whenever cash flow changes sign? See, here it is negative, here it is positive, again negative, again positive. In such case, what happen? You will get two IRR, you will get multiple IRR, means more than one IRR, right? You may see that your return is 40%, but actually it is not. So in that case, NPV always gives you the real value. So remember, this is the limitation of internal rate of return, that in unconventional cash flow, internal rate of return does not work, right? Internal rate of return does not work. Rather, we have to rely on NPV, net present value. right? So in the upcoming session, we will discuss that how to find the net present value of a case, because this is super important, right? So I hope the limitation is clear to you, right? So this is the point, that multiple IRR is the symptom. The core issue is IRR potential to mislead, right? So that is the point. Now let's look at this question. This is another question based on the same discussion which we have just done now. So is what is happening here, that TakeX Limited is evaluating a project with the following cash flow. Company cost of capital is 100%. We will discuss what is WACC. I will just discuss in the upcoming lecture. And the project IRR is 25%. But the finance team is concerned that assuming reinvestment as 25% is unrealistic, right? So here you see the cash flow. Again, earlier it was negative, then this is a conventional, not unconventional. This is a conventional cash flow. Means initially you have invested $200 million, and in first year you are getting $150. In second year, this is your cash inflow. In third year, this is your cash inflow. Right. So this is this TakeX Limited evaluating a project. Right. Cost of capital is given. Project IRR is 25%. Internal rate of return is 25%. But the finance team is concerned that assuming reinvestment at 25% is unrealistic, right? So question is, what is the primary advantage of using MIRR? This is called modified internal rate of return, our IRR. One is IRR, internal rate of return, other is MIRR, which is called modified internal rate of return. So option number A, it says that MIRR eliminate multiple IRR issue by adjusting for unconventional cash flow. Option B, MIRR assume reinvestment at the cost of capital, making it more realistic. Option C, MIRR always gives a higher return than IRR. And option D, MIRR ignore the terminal value, simplifying the calculation, right? So this question will tell you what is the advantage of modified internal rate of return over internal rate of return. See, IRR. IRR tells you the rate of return at which your project NPV, at which your project net present value will be equal to 0, right? That rate of return at which your NPV equal to 0, that is called IRR. But IRR quietly assume that every rupee or every dollar you earn get reinvested at the same rate, right? This is one of the assumption of IRR. It assumes that whatever rupee you earn, right? Whatever rupee you earn, right? It get reinvested at the same rate. So suppose IRR is what, 25%. So suppose IRR is 25%, it assumes that you are reinvesting at 25%. It may sound unrealistic, because it is unrealistic. In real life, what happened? Company invest at their WACC. Company reinvest at their weighted average cost of capital. What is the WACC? Weighted average cost of capital. How to find it? I will just tell you in the upcoming slide. Right. So what happened in the real life? That company don't invest at 25%. They invest at the weighted average cost of capital. Reinvest, which is how much? 10% here. That is your real world return from the reinvestment. Right. So this is where modified internal rate of return steps in like a hero, right? So it says, let's be practical, let's reinvest at the company cost of capital, not some high dreamy IRR, right? So MIRR say, let's be practical, let's not be unrealistic. What MIRR say, that let's reinvest at the company cost of capital, right? Which is not some high dreamy IRR. This IRR is very high, 25%. So while IRR shows optimistic, it shows an optimistic picture. It shows an optimistic picture, but MIRR gives you a realistic picture, right? So what is the correct answer now? Can you tell me? What is the advantage of MIRR over IRR in this scenario? Option number A, MIRR eliminate the multiple IRR issue by adjusting for unconventional cash flow. No, this is wrong. That is what NPV does. That is done by NPV, net present value, right? So what about option B? MIRR assume reinvestment at the cost of capital. Yes, this is the correct. See, IRR reinvesting at 25% is optimistic. It look optimistic, but it's not realistic. So MIRR say that rate reinvest at the cost of capital, which is 10%, right? We should reinvest at the cost of capital. That is what make it more realistic. Option number C, MIRR always give a high return. No, this is wrong. And MIRR ignore terminal value. No, this is also not wrong. This is also wrong because it takes terminal value into consideration, right? So this is one of the advantage of having MIRR over IRR, right? That is called modified internal rate of return. So it assumes that reinvestment should be at the cost of capital. It should not be at the IRR, right? So that is what it explained regarding the MIRR. Now let's look at one more concept. So till now we have discussed the two limitation of IRR. The first limitation was in the case of unconventional cash flow. In the previous question, right? In the case of unconventional cash flow, NPV always work better. And second question we have just discussed that realistic assumption, unrealistic assumption. This is one of the limitation of IRR, right? Now let's look at this particular case. Now let's look at this particular case. Here also you can see the cash flow are, what is happening in this case. As you can see that let's look at a construction project. The cash flow is in $1 million. Initially they have invested $500 million. First year they have got $800 million. Second year 300 minus 300. That is they have their cash outflow. And third year is $200 million. They have get this much. Now this project has two IRR, 12% and 28%, right? And the company finance team is scratching their head, causing confusion, right? But they also calculate the MIRR and they get MIRR at 15% using WACC is equal to 10%. Now the question is, why does MIRR provide a better decision making tool as compared to IRR? Option number A, MIRR remove ambiguity by providing a single rate. Option B, MIRR always matches NPV, eliminating the conflict in project evaluation. So these are project evaluation technique, NPV, IRR, MIRR. This is way we evaluate the project. Option C, MIRR ignored negative cash flow, simplifying analysis. Option D, MIRR uses a zero discount rate. So question is in which why does MIRR provide a more reliable decision criteria, right? So suppose what is happening here. Suppose you are baking a cake. Suppose you are baking a cake. You check two recipe book, right? One say bake for 12 minutes, another say bake for 28 minutes, right? You are confused. Will it be undercooked or burned? That is what happened with the multiple IRR, right? Suppose you are baking a cake. You look two recipe book. One recipe book say that you should bake for 12 minutes. Another recipe book say you should bake for 28 minutes. You are confused that will it be overburned or will it be undercooked, right? So that is what happened with the multiple IRR, right? This IRR can give more than one answer when cash flow changes direction. In this case, you can see initially it is negative, it become positive. Again negative, it become positive. So cash flow is changing the direction, right? So it IRR can give more than two values, right? More than one value. So that is where MIRR steps in, like your trusted grandma recipe. MIRR say, don't worry, I have considered everything, inflation, reinvestment, cost, and here is one solid answer you can rely on. So can you tell me what is the main advantage of MIRR? Is it A, B, C, or D? Just waiting for your response. What is the main advantage of MIRR? Why MIRR is a more reliable decision criteria? What do you think is the answer of this? I hope I have explained this thing. What is one of the main advantage of MIRR over IRR? Option A, it removes the confusion, that it removes ambiguity. No. Answer is option number A, right? The answer is option number A. MIRR remove ambiguity. It remove the confusion by providing a single rate, unlike multiple IRR, right? This is the correct answer. So IRR can be confusing if cash flow goes up and down, right? So multiple IRR means multiple answer, right? And obviously big confusion. So MIRR just give you one answer, right? It uses cost of capital for reinvestment and discounting, so it is much more practical, right? So it used two things, MIRR used two things. It used WACC, which is weighted average cost of capital, right? And discounting. So it is much more reliable. So always trust MIRR when things get messy. That is the point. Now come back to this question. Now this one is a little different. Here you have to calculate the profitability index, right? So we have discussed what is MIRR, what is IRR, what is the advantage of MIRR over IRR, and what is why NPV, net present value, they have a big advantage over IRR. Now come back to this question. See what is happening in this case, that three projects have been given, A, B, and C, right? So Protec Limited is evaluating. Let me zoom a little bit. Right. Protec Limited is evaluating three manufacturing projects A, B, and C. For project A, initial investment 5 lakh, discounted cash inflow 6 lakh, profitability index they have given. B, C they have given. All every data have been given. Right. Now what happened? The CFO say go for project A because the PI is the highest. The CEO say that project no. Project B gives us 12 lakh in return. Right. It gives us 12 lakh in the return. that is double of what A give. Now the question is, which of the following explain why profitability index might not be the sole criteria for project selection, right? So which project to choose, right? Option number A, PI ignore absolute return, favoring a small project with high ratio of a larger one. PI means profitability index. PI assume constant reinvestment rate, which may distort ranking in dynamic market. Option number C, project with PI less than 1 can still be profitable depending on cash flow timing. And option number D, net present value is always better than PI regardless of project scale. This PI, which means profitability index, is another way of evaluating the project. This is another way to evaluate the project, right? So let us break it down. What is the meaning of PI? Let me explain. Imagine that you invested rupees 1. You have invested 1 rupees and you get back 1.20, right? That is great, right? You have invested 1, you have get 1.20 back. So PI tells us it is the return per 1 rupees invested. PI, what it tells us, what is the return you are getting per 1 rupees invested. That is called PI. So what is the formula for PI? The formula for PI is present value of return and divided by initial investment. Means for every 1 rupee you are investing, how much you are getting. That is called PI. That is called profitability index. Now you can see for both project A and B, PI is same 1.20 and 1.20. But here is a twist, that project A gives you 1 lakh profit, isn't it? You can see you have invested 5 lakh and discounted cash inflow is you are getting 6 lakh. And project B, it is giving you 2 lakh profit. You can see it here. So even with the same PI, which give you more money? Obviously project B. So please, one question I'm asking you, which project would you prefer? Option A project that gives you more return, a project that gives you more return per 1 rupees. Option B, a project that gives more rupees overall. Tell me, which one would you choose? Which one would you prefer? Suppose two options are there. Would you prefer a project giving more return per 1 rupee, or would you prefer a project that gives you more rupee overall? You see, that is what is happening in A and B. In case of A and B, both are having the same profitability index, but B is giving you more return. So which project would you choose? Project option A, project having giving more return per 1 rupee. That means project having more PI, or project that is giving you more rupees overall. Option A you are saying. Okay. So that is exactly the debate that CFO and CEO are having. So PI is not all. Obviously option A, no. See, this is, you will choose option number B, not option A. That gives you more rupees overall, right? So PI, that is profitability index, is not always a standalone tool, because it ignores the absolute return. And can favor a small project. As you can see here, now, right? In this case, what is the profit we are getting? 2 lakh. In this case, what is the return? It's just 1 lakh, right? So PI ignore absolute return and can favor a small project. It tells us how profitable the project is per rupee invested, but now how much total profit we are making, right? You can think of it like this. Suppose you sell 10 cup of tea. Try to understand. You are selling, let me change the color, right? Suppose you are selling 10 cup of tea, right, with rupees 2 profit each. So on 1 cup of tea, you are getting rupees 2 profit. You are selling 10 cup of tea, which rupees 2 profit on 1 cup of tea. But someone else sell 1,000 cup of tea with just 1 rupees profit. So who is earning more overall? Right, obviously this one. So you have just sold 10 with 2 rupees profit per tea, but someone is selling 1,000 cup of tea with 1 rupees profit. So obviously this 1,000 person is earning more. That is why volume matter. That is why volume always matter. So what we learned. So what is the answer to this question? So tell me, what is the answer to this question? So the answer is option number A, that PI ignored absolute return. Yes, this is the limitation of PI, right? So the PI ignored absolute return. It favors a smaller project with higher ratio over larger one. This is one of the limitation of PI. How do we calculate the PI? Per rupee you have invested, how much you are getting. That is called PI, right? So that is one of the limitation of profitability index, right? So it just tells you it just tells you how much profit you are making per rupees invest. It is great, it is great for comparing relative profitability. But when projects differ in size, PI alone can be misleading. So what we do, we use PI plus NPV, right? Both are used simultaneously to make a smarter decision, right? To make a smart decision, we use profitability index as well as NPV, right? That is what we do. So option number A is the correct answer here. It ignored the absolute return. That is the limitation of PI, right? Now let's look at this particular question. Again, one question based on ARR, right? This one is little bit different, right? I think we have already discussed ARR. Let's come back to it. What is happening? A manufacturing company is planning to invest 50 lakh in a new machine, and machine life is given 5 year, right? No salvage value. Project is expected to generate a total return of 30 lakh over its life, and company can use straight line depreciation. So what is the ARR for this project? And tell me, what is the ARR? We have already discussed the ARR, accounting rate of return. So it is the average return that you earn every year on your original investment. It's like asking, suppose I invest 1 rupee, how much profit do I get back every year on average, right? That is called accounting rate of return. So here nothing is mentioned which version to use, right? So what we will do, we will apply the simple version. We will apply the simple version, right? So what is the formula for ARR? Just can you tell you, calculate the ARR? What is the ARR value? So it is nothing but average annual profit in the numerator. Overall ARR you have to find, divided by initial investment, right? Multiplied by 100. So ARR use accounting. One thing you must note it down. ARR use accounting profit, right? ARR use what? Accounting profit, right? It does not use the cash flow. That is the difference. ARR always use accounting profit. ARR does not use the cash flow. That is why we must adjust for depreciation. This is one point. So you have to adjust for depreciation. So can you calculate what is the average annual profit? Can you calculate what is the average annual profit in this case? Please tell me what is the average annual profit in this case. So this profit, you can see this 6,000. What here you can see. So see how much is the project is to generate total earning of 30,000, 30 lakh over its life. Fine. And so what is the depreciation per year? So first thing, average annual profit. What is the average annual profit? Total earning is how much? 30 lakh. So how much is the average annual profit? It is nothing but 30 lakh divided by what? How many year? 5 year. So that is average, which is how much? 6 lakh. So 6 lakhs your average annual profit, right? But we have to take depreciation also into account because it shows accounting profit. What is the depreciation per year? Because it is written straight line depreciation, so it means depreciation will uniformly decrease over the year. So depreciation per year will be how much? 50 lakh, which is the initial amount, divided by 5, which is how much? 10 lakh. So this 10 lakh is the depreciation, right? 10 lakh is the depreciation. So we add back the depreciation because it is a non-cash expense. We have already discussed it, right? This depreciation, it just kept on the paper, it just written on the paper, but it not actual decrease. So since it's a non-cash expense, so we add it back, right? So what is the adjusted profit? What is the adjusted profit? Adjusted profit is 6 lakh plus plus 10 lakh, right? Depreciation. So it is how much? 16 lakh. So this is your adjusted profit. Now we have to find the ARR. So what is ARR? 16 lakh divided by initial investment. How much we have invested? 50 lakh, right? So how much it is? I think it is 32%. Right, 32% will be more accurate here. Right. So I think there is some mistake in the option. So this way you have to calculate it. It is 32%. And what is the benchmark? It is 15%. So you should accept the project. Right. Minimum required ARR is 15%. You should accept the project. You will add back the depreciation to calculate the adjusted profit. And that is how we calculate the ARR in this particular case. Now friends, let's come to CAPM. That is called, what is CAPM? CAPM formula we will apply in this case. So what is happening here? That imagine that you are a venture capitalist, right? Someone who invests in risky startup, and you are hoping for a return. So here you can see risk-free rate they have given is 4%, expected market return is 12%, and beta value they have given is 1.8, right? So using CAPM, what return should you demand from this startup to compensate for its risk? So what is CAPM? CAPM, is capital asset pricing model. Capital asset pricing model. So it helps investor answer this question, that how much return should I expect for taking on the extra risk? This venture capitalist is taking the extra risk. So obviously, since they are taking extra risk, so they should get the extra return, right? So this CAPM tells the answer, that how much return should I expect for taking the extra risk. So can you tell me how to go about calculating the extra risk? Basically, there is a formula. There is a formula to calculate the CAPM. So the formula is, it is very simple. That it says that required return. It says required return, which is RE. RE is equal to risk-free return plus beta multiplied by market return minus risk-free rate. Right. So this formula you have to apply. So now in this case, what is what is the meaning of risk-free return? So can you apply the formula? Just put the value. So what is the risk-free return? Risk-free return means what you earn with zero risk. There are some investment where risk is zero, like government bond is there, right? That is risk-free rate. And what is the market return? So in short, we can also write it like this: RE is equal to RF plus beta multiplied by RM minus RF. So this is the formula. So what is market return? Market return means what you expect from the entire market. And what is the risk rate? We have already discussed. What is this beta? Beta, this means how much riskier the stock is as compared to the market, right? So just you have to plug in the value. So the formula is RF plus beta multiplied by RM minus RF. So what is RF here? So RF is 4%. What is beta? Beta is 1.8. What is RM? This is 12%. What is RF? RF is again 4%. So how much you are getting? Okay. So let me explain. See, 4% plus 1.8 times 8%. So 1.8 times 8, how much it is? 14.4%. So the answer is 18.4%, right? So option number B is the answer, right? So this formula you have to remember to calculate the adjusted required rate of return, right? So this is the minimum return that investors should demand. Minimum return based on the risk they are taking. How much return they should demand? 18.4% return they should demand. So CAPM, what is the implication of CAPM? It shows you the minimum return that investor should expect based on the risk they are taking. And if beta increase, higher the beta, higher the required return. RE will increase, right? So that is the point. Just this formula and you can answer it question. This is the formula we have used. Now let's look at this question. So basically, investor is comparing two stock. This is called CAPM. CAPM stock comparison, right? Capital. What is the full form of CAPM? Remember, capital asset pricing model. Now friends, come back to this question. Let's say you are investor checking out two options. Stock A is there in utility company, very stable, beta is 0.6, and stock B is there in the biotech firm, and which is high growth and beta is also higher, 1.5. So market condition given, risk free rate is 5% and market return is 10%. So which of these has the highest expected return? Which statement is correct based on the CAPM, right? So CAPM answer, if I take more risk, how much more return should I expect? Right. So option number A, that stock A has higher expected return because it is less volatile. Option number B, stock B required return is 12.5%. Option C, both having the same return. Option D, stock A required return is negative. So can you calculate the rate of return? Just apply the formula. Yes, 18.4 is the correct answer in the to the previous question, right? I think you are answering the previous one. Very good. Now, can you calculate here what is the required rate of return for stock B and stock A? First of all, let's calculate stock A. So for stock A, RE is equal to risk-free rate is 5% plus beta is 0.6 multiplied by multiplied by RM is 10%. 10% minus 5%. So how much it is? So 10 minus 5 is 5. 0.6 of 5 is 0.6 of 5 is 3, right? So 5 plus 3, it is 8%. For stock A, it is 8%. What about stock B? What about stock B? For stock B, beta they have given it 0.5, right? So RE is equal to 5% plus 1.5 multiplied by 10% minus 5%. So how much it is? It is 5% plus 7.5%, right? I think it is 12.5%. So you can see for stock A, RE is 8%, and for stock B, RE is 12.5%. So stock B should offer at least 12.5% return to match its risk. And stock A is low risk, low return as expected. So now tell me which option is correct? Is it A, B, C, and D? Yes, correct. It is B because stock B required return is 12.5%, reflecting it higher risk, right? 12.5%. So because you can is it clear? Please tell me. I hope it is clear that how to find the required rate of return for both the stock. Just you have to apply the formula using CAPM, capital asset pricing model, right? So what we learn from this question is that if beta is higher, you can see for stock B beta is higher, right? So what is the learning from this question? That if beta is higher, it means risk is higher. It means return it will also be higher. Like in the case of stock B, you can see beta is higher, risk is higher, return will also be higher, right? Please tell me, is it clear now? How to go about calculating the CAPM? Very good. Now let's do one more question. So see this question. This is a good question on APT. See what is happening in this case. Let me explain. Imagine a company called Beta Security. The company name is Beta Security. Let me zoom a little bit, right? And it is evaluating a stock. So this is now we are evaluating a stock. We are doing evaluation of a stock, right? They are evaluating a stock using arbitrage pricing theory, using APT, which unlike CAPM use multiple economic factor. In CAPM only use one economic factor, while this APT use multiple economic factor. Like you can see GDP growth, inflation rate, gold price, stock market index return. These are the multiple factors to calculate the expected return. The the goal is simple. The goal is to calculate the expected return. This is the goal, right? But in this case, they are using the multiple factor: GDP growth, inflation rate, gold price, etc., etc. Right? So the question is the data have been given. What action should Beta Security take based on APT calculation? Buy the stock, sell the stock, hold the stock, ignore APT. So let me tell you the formula. What is the formula for calculating the expected return using APT? So what you do, first you write the risk-free rate plus beta multiplied by risk premium, right? For each factor, right? So you can think of it like cooking a dish. Suppose you are cooking a dish. In a dish there are many ingredients. So many ingredients are there, and each ingredient is adding its flavor, right? And you add all of them, right? So basically here it will be summation will be more suitable here. Summation to use. So now here factor has been given, and beta and risk premium have been given. So what I will do, I will draw a table here. The table is the best way to calculate it, right? So we have to calculate what? We have to calculate the expected return. So no need to draw table, you can see. What about the GDP growth? See, we will calculate the expected return step by step. So just multiply this 0.5 with 3%. 0.5 multiplied by 3, it is 1.5%. Then 0.7 multiplied by 2. 0.7 multiplied by 2, it is 1.4%. Then minus, you see my negative, it is beta is negative, minus 0.6 multiplied by 4%. How much is this? It is minus 2.4%. And here 1.2 multiplied by 8%. How much it is? 9.6%. Now you add all of them. You add all of them, and you have to add what this risk-free rate 2%. So first write risk-free rate 2% plus 1.5 plus 1.4 plus, so minus 2.4 plus 9.6. What is the final answer? Tell me what value you are getting. This is the formula to calculate the risk required return using APT, arbitrage pricing theory, right? So multiply beta with the risk premium, add all of them, and you also add the risk free rate. So 2 plus 1.5 is 3.5, 3.5 plus 1.5 is 4.9, and plus 9.6 minus 2.4. So I am getting 14.6. Are you also getting the same? I hope you are also getting the same, 14.6. So this is what you get, risk expected return. So basically, do you think that a stock is undervalued? Right? Do you think that because the stock market price suggests return of 12%? See what is happening here. That the stock market price suggests return of only 12%, and now we have get 14.6%. Do you think that a stock is undervalued if its actual return is less than what models say? What do you think? So see what I'm asking you. So the question is what you should do in this case: buy the stock or sell the stock. So APT says, what APT is saying, that stock should give 14.6%, but the market return is only how much? 12%. So isn't it an arbitrage opportunity? It is an arbitrage opportunity, right? You know what is the meaning of arbitrage? In BFM we have learned the arbitrage, right? So the stock is undervalued, right? The APT is telling that return should be 14.6%, but the market price is suggesting the return of only 12%. So here we can take the arbitrage opportunity. And a smart investor grab such chance, right? The smart investor, one who is smart, they grab such kind of such chance. So what they should do: option A, buy the stock. Option A, buy the stock as the calculated expected return exceed the market return. Please answer now. I hope I have given you sufficient insight. Option B, sell the stock as the calculated expected return is lower than the market return. Hold the stock and ignore APT. What do you think? Should they buy the stock? See, market is suggesting a return of only 12%, but APT says that return is 14.6%. What should you do? So that is what you have to answer. So basically, this stock is undervalued. Valuation is less as per the market. The correct valuation should be 14.6%, but market is just only saying 12%. So whenever a stock is undervalued, what should you do? You should buy the stock or you should sell the stock. Just waiting for your answer. Right? This is what arbitrage opportunity. Yes, option number A, very good. You should buy the stock. Yes, this is what you should do. Right? Because you should buy the stock as it is undervalued. Why option B is incorrect? The sell the stock. Because return is higher, not lower. Right? Because it's saying that calculated expected return is lower. No. It is higher. Had it been lower, then we will sell the stock. Hold the stock. This is wrong. APT whole point of view is to spot mispricing and act on it. You can see that is why it is called arbitrage pricing. Why it is called arbitrage pricing? I think you know the answer. Why it is called arbitrage pricing? This question explain it. Why there is a mispricing here, isn't it? This is called mispricing. This is mispricing which has happened here, right? The correct pricing is 14.6 and market is only telling 12%. So this is called mispricing, and you take advantage of this mispricing. You buy the stock as it is undervalued, right? And a smart investor grabs such chance. And option D is completely wrong. It ignored APT. That is wrong. But APT gives you deeper insight with more real world variable than CAPM, right? Please tell me, is this concept clear or not regarding APT? I have given you every dimension of APT, right? That how you can calculate the required rate of return, why it is good as so if I ask you which method is more good, CAPM or APT, what would your answer would be? Which method is more would you prefer? CAPM, that capital asset pricing model, or this arbitrage pricing theory? Tell me which method is more preferable. And why it is called arbitrage pricing? Because it takes advantage of mispricing, right? Undervalued stock, like you can see in this particular question, right? Very good. So friends, that's all for today, right? We have covered starting from accounting rate of return, IRR, NPV, right? Net present value, and we have seen CAPM, right? Yes, obviously arbitrage pricing model is very good, is very good in comparison to the CAPM model, right?